Freeze frame. You're staring at the balance on your business bank account. 80 grand. That's the kind of money that could buy a Tesla, a tiny yacht, or, if you blink at the wrong moment, an HMRC-sized crater in your wallet. Meet Sarah. She's swapping contractor chaos for a cushy permanent gig. Same laptop, new payslip, but that £80,000 is still marooned inside her limited company, begging to escape. If she just yanks it out as a dividend, the taxman grabs a third. Imagine slicing off a third of your pizza before you've even tasted it. Crime scene stuff. Enter the master key, a member's voluntary liquidation. Sounds like a funeral for businesses, but it's actually a champagne-popping goodbye party for solvent companies. Sarah hires a licensed insolvency practitioner, signs a few papers, and boom, her dividend morphs into a capital distribution. Suddenly, she's dancing to the capital gains tax beat, not income tax heavy metal. Now sprinkle in business asset disposal relief, BADR, a name only its accountant mother could love. Qualify and you slash capital gains tax down to 14%. Sarah ticks every box. She owns 5% plus, was the director for years, and the company stopped hunting clients less than 3 years ago. Her tax bill melts from £27,000 to about £10,800. That's nearly £16,000 saved, enough for a round-the-world trip or, groceries in London. But like the title said, destination matters, so let's swap hemispheres. After 10 years in the UK, Tom's boarding a flight back to New Zealand, family in tow, determined never to hear the phrase British drizzle again. He's lugging the same £80,000 problem, except his solution lies 11,000 miles away. Introducing New Zealand's transitional resident rule, which gives returning Kiwis a 4-year tax holiday on most foreign income. So, dividends from a UK company? Practically duty-free. So Tom has 2 buttons he can push. 1. Business asset disposal relief before wheels up and pay 14% in the UK. Or 2. Land in Auckland, become NZ tax resident, wait until the UK tax year closes, then rain dividends on himself. 0 UK tax, 0 NZ tax, total eclipse of the tax bill. The catch? Timing must be Rocket Lab grade precise. Draw a dividend while still UK resident and it's game over. Miss the 4-year New Zealand window and you're back in the regular tax orbit. But before we go, a warning if you think you can outfox the tax code, meet TAR, the Targeted Anti-Avoidance Rule, skulking in the background like a debt collector in a horror movie. Close one company, Rise Phoenix style, with a near-identical twin inside 2 years, and HMRC will snatch your gleaming capital and stamp income on it before you've finished your victory lap. It also pays to remember, none of this is carved in granite. BADR's 14% bargain jumps next April. The CGT allowance keeps shrinking, and Wellington could revoke its 4-year tax holiday faster than you can gripe about the exchange rate. So while Sarah and Tom prove the exit can be a legal heist, pull the wrong lever and you bankroll someone else's motorway, but pull the right one and you're biting into hot chips on a Kiwi beach with change to spare. So you have been warned. Parliament loves a last-minute plot twist, so keep reading, stay informed, and never assume tomorrow's rules will still let you win today's game. And remember, with no worries, you'll know both when to take off and where to land.